Hello and welcome to financialexpress.com. I'm Shaleen Agrawal and I have with me my colleague Zoya Springwala. Today we are talking to Churchil Bhatt of Kotak. Churchil, thank you so much for joining.
Yep, pleasure to be here.
Churchil, last some time, debt yields have gone up significantly. And there is a lot of chatter on why investors should put in some of their money or some of their portfolio into debt instruments. Could you just give us an overview on what's happening there?
Sure. So see, debt markets are typically cyclical markets and they are guided by central banks. So they determine the policy rates, and the markets and every other fixed income instrument, including your loans, home loans, personal loans, corporate loans, every related instrument moves in line with the guidance given by the central bank. As we all know, that pandemic related disruptions meant that central banks had to ease policies and bring interest rates down, far too lower than what they would otherwise be in order to support the economies. And once we exited the pandemic, not only did the central banks have to scale that rates back to where the normal levels used to be, but also a bit higher, because the kind of, economic circumstances that were engineered during the pandemic led to a bit of inflation locally as well as globally. So if you see over last 10 to 11 months, we have seen probably one of the fastest ever cycle of global rate hikes, not necessarily just local, I'd say, but at least one of the fastest global rate hikes on record across most major central banks, barring very few exceptions. We have seen central banks hiking rates. From an extremely accommodative policy rate, real rates in most economies have turned near positive, if not outright positive. And wherever they haven't turned, the indications are that going forward within a matter of months, they will turn positive. So obviously, this leads, the investors in fixed income markets to believe, and rightly so in many cases, that at least the central banks are more or less done with their rate hiking cycles. So the policy rates have peaked. And if policy rates have peaked, at least in the cyclical sense of the word, then we may see a bit of a pause in those policy rates before they head the other way. And so, yeah, there are suggestions across, many investor communities of locking in these peak interest rates.
For an investor, how does it work?
Okay. So like I said, fixed income markets are cyclical markets. And broadly, for an investor who is interested in investing and not intermittently withdrawing his money, fixed income offers a reasonable certainty of returns. So if you hold a product for its lifetime, then you are likely to earn, or you will earn the yield at which you have purchased a fixed income product. It's very similar to how a fixed deposit works. If you don't break the fixed deposit in the interim, then whatever rate the banks have promised you is what you are likely to earn at the end of the tenor. And considering that the rates overall have peaked, some investors want to lock in these rates for longer tenors. So if you see, fixed deposits are normally, shorter dated instruments. Banks rarely offer, meaningfully long tenor fixed deposits. When I say meaningfully long tenors, I mean 10 year, 15 year, 30 year. I personally don't see that kind of a product prevalent in the market. But there are instruments like long tenor bonds or insurance products or long duration mutual funds. For probably, more advanced set of investor, even instruments like REITs or debt AIFs or wherever. So there are gamut of instruments which allow people to lock in these higher rates for a choice of tenor that is suitable to their, investment horizon. I would say anywhere ranging between 2 to 5 to even 15 to 20 years. And a portion of portfolio in that segment definitely makes sense because the beauty of fixed income is that it gives you a reasonably well defined return for a horizon of investment. Unlike equities, where while the longer tenor returns may be slightly superior, and even that may be debated depending on the circumstances and the level at which one invests. But equities do not necessarily guarantee returns to an investor exactly when he wants it. So if I had saved for my daughter's marriage, and if I needed that money in March 2020, odds are I didn't probably get the kind of return I expected to get. But if I did not have a fixed withdrawal horizon, then yeah, it may give me a return over a longish period. So a segment of the secured or almost secured or guaranteed kind of returns makes sense. And that's where fixed income chip in as a part of any portfolio allocation.
Sure.
The debt market is usually seen as investments for risk-averse or conservative investors. But with the current interest rate scenarios, how is the landscape changing with the influx of investors who are simply looking for higher and better returns and are not as risk-averse or conservative?
I understand. So let's look at it this way. Say, for example, if you look at average returns of US debt investments over last 35, 40 years, odds are they are commensurate, if not better, with the equity returns. Similarly, some of debt funds in India as well have over last 20 years delivered far stupendous returns. Debt returns are largely a function of timing because, like I said, interest rates are cyclical, and they reward investors who catch or who relatively are better at timing the peaks of the rate cycle. Nobody times the exact peak, but in and around the peak. And reward the investors who probably also, are patient enough with their time horizon. But it is not necessary that debt returns are only for the risk averse or are inferior at all points in time. They may, under many circumstances, be commensurate and in some cases even better than other forms of investment. Now, coming to the second part of your question, can you guide me specifically to that?
As I was saying, the current landscape, given the higher interest rates and repo rates, is allowing debt to give better yields, better returns. So, typically debt is seen as an instrument, a way to invest for conservative investors. Like you said, it's not necessarily true, but we have investors who are not as risk averse or not as conservative, still moving to debt for these higher returns. How is this changing the landscape of the debt market in general?
Okay, fair. So India always had, in my opinion, a very savings-friendly population. We believed in savings, and we always had allocation to some or the other fixed income or relatively safe investment. This is not to say that other investments don't have a space. An investment portfolio will have space for all kind of risk adjusted return instruments. Currently, while the interest rate cycle, at least the policy rate cycles seem to be near their peaks, it is not necessary that makes all kinds of fixed income equally attractive. So say, for example, your credit spreads, which is to say your spreads for taking risks in instruments which, give you higher returns because you are giving money to a corporate or to somebody with a higher credit risk profile than a government. So these instruments normally give you a kicker over what the government would pay you because of the nature of the credit profile of the issuer. I believe at this point in time, credit spreads are not necessarily the most attractive, and there may be some scope of normalization in that space. Similarly, I would also say that while a lot of
Churchil, normalization towards widening the spread or normalization towards narrowing the spread?
I would say normalization towards widening the spread. Now, the widening can happen, in one of the two ways. Either the corporates yields go higher or government yields fall more than the corporate yields fall.
Sure, please continue.
So the latter is more likely to happen. But having said that, the risk-adjusted return on credit spreads is not as attractive as history has normally given to an investor. Similarly, I would say that, the yield curve currently is reasonably flat. In fact, in pockets, it even looks inverted, and it is inverted. So say, for example, your 5-year bond, your 10-year government bond, as well as your 30-year government bonds are all trading very tight in a 10 basis range within India. And this may sometimes surprise, people, because normally an investor expects higher returns for giving money for a longer tenor of time, because his commitment of the funds is higher. He would normally expect a higher return. But when interest rates are peaking and market participants believe that, over a 10-year, a 15-year, or a 30-year period, this rate is far too attractive to let go of, that is when yield curves flatten. But that also takes away a bit of attractiveness of duration. So while duration is the name of the game when one wants to play the interest rate cycle, if the forward-looking markets have priced some bit of it already, then to that extent, the relative attractiveness reduces.
So in that case, for an investor, does it make sense to invest in medium-term securities or longer-term securities?
So I would say, I personally at this juncture prefer, a 15-20-year bucket rather than a longer bucket. If somebody has a relatively shortest horizon, even 5 to 7 year buckets on the government security curves look very attractive. In terms of credit profile, I would recommend, investment in state government bonds, which offer returns commensurate to corporate credits, and, in that sense, carry much less inherent issuer risk. So at current juncture, the due to the nature of the yield curve and the structure of the markets, these seem to be the more attractive points.
One thing which I want to understand purely as from a retail investor's point of view, I'm a retail investor. If I invest in a mutual fund, which invests primarily in the long-term government bonds or long-term duration bonds.
Sure.
What happens to the yearly returns? Does the yearly return fluctuate along with the interest rates as we go forward, or do the interest rates get locked in at my purchase as of today?
So, okay, to be fair, when money is invested in a mutual fund, the fund manager is also expected to manage the portfolio with some amount of active perspective. And that kind of takes away the guaranteed part of the return, right? Because the fund manager at his discretion and in his wisdom may sell a certain security, buy another security, change the duration of the portfolio within the mandate of the prospectus. So yeah, if the investment product is mutual fund, there is some amount of built-in market risk along with it. The market risk is not as high as equity, but it remains. And for a layman, the way one should understand is that his debt NAV will rise with falling interest rates and will fall with rising interest rates. So that is a safe way. Also, like I said, the bank FDs provide, say, for example, instruments of up to 3 to 5 years. Even mutual funds really don't provide so-called very long-term returns. So if somebody wants to lock in a portfolio with a reasonably longish horizon, say 20, 25, 30, or even 15 years, then one has to move towards what I believe is the insurance savings product. And globally, this is the case. So for each duration of investment, these are the globally accepted sectors which offer, the kind of products.
Sure. So right now, in simple words, for an investor looking to move away some of the risk from equities, now is the right time. We have established that because of the higher interest rates, higher yields. What does it make? What makes more sense to shift some of the money into shorter term or medium term debt instruments or longer term debt instruments right now?
Okay, so now let me put it this way. This will be largely a function of the availability of fund with the investor, right? Because not every sum invested is available for 5, 10, 15 years. And similarly, also a function of risk appetite. If an investor does not want to see market fluctuation, they may probably look at fixed deposits. If one is looking at a 2 to 3 year horizon, I would say a good dynamic bond fund at this juncture makes more sense than a short duration fund. If one is looking at beyond 7, 10 years, then I would say a guaranteed return insurance products makes a lot more sense. So it depends on which horizon is one looking at and what kind of volatility is one willing to accept in his NAV.
Interesting that you haven't mentioned about investing in short-term bond funds. For example, either liquid funds or shorter duration bond funds. Why is that?
Okay, so liquid funds and short duration funds give you the yield prevalent today.
Yes.
But they inherently carry very little or limited duration, which is to say when rates fall, they tend to benefit less than other funds. And if one is looking to take advantage of peaking interest rate cycle and is willing to be patient over say 18 months to a 36-month horizon, then they would also want to benefit from the fall in yields by sitting with some duration in their portfolio. And that would not come from a liquid fund or a very short duration fund.
Zoya, you have any questions right now?
No, nothing else.
Churchil, where do the yields go from here?
Okay. So broadly, let us put it this way, that current backdrop in yields is a combination of global backdrop and local backdrop. Now, locally, the backdrop, if you ask me honestly, is far simpler, much well understood, and more or less a templated one. So currently, as we sit, there is a very good chance that Reserve Bank of India is more or less done with their rate hiking cycle. Real rates, 6 month forwards, 1 year forwards look positive. And for a foreseeable future, it does seem that the headline CPI or the inflation rate will remain within the tolerance band of Monetary Policy Committee. So no further adverse central bank related action will be required from the domestic horizon. If anything, the growth is likely to slow a bit due to local and global factors, and that will only support at least the peak rates, if not fall in rates, in the near term. The global backdrop has honestly far divergent and extreme views. And a lot of our inflation and growth dynamic is imported. Whether we like it or not, we live in a connected world and it matters to us. And if large economies globally are uncertain about their inflation outlook, so some of them seem to believe that there are structural changes in the nature of global inflation, geopolitics has worsened, countries are not going to trade as freely with each other, they're probably going to be more conservative, they will want to create energy securities even at a higher cost. In that circumstances, there is, and I'm not saying that none of these things are not happening, but they will have some impact on global inflation and on the adverse side. So these factors will probably keep global inflation a bit higher than where it has been over last 20, 30 years. At the same time, outstanding sovereign debt globally is also at such a level that if their rates remain too high, then their government finances will start to look vulnerable. And I'm sure no central bank or government would find it in their own national interest to continue to do so. So rates cannot probably stay very high for very long, but they may not go back to what otherwise was a period of very low rates as well. This leads me to believe that globally rates will settle lower from where we are, but higher than what last 20-year average suggests.
Sure. In this conversation, you have mentioned twice or thrice that you don't see RBI raising rates further. And with some confidence, you have said that. What gives you that confidence, even after January inflation numbers?
Okay. So when I say that RBI is likely to not hike rates, I'm sure nobody is 100% confident about anything in financial markets. Having said that, the odds of that happening are high because central banks are not necessarily focused only on one or the next immediate reading of inflation, but an overall economic backdrop. They have taken a lot of action. RBI themselves have hiked rates from 4% to 6.5%. That's 240 basis points. As we converse, a lot of home loan rates have been revised from sub 7% to almost 9%, if not higher. The impact of all these actions are seeping into the economy, and they take time to materialize. It's not as if RBI turns on a switch and there is light. So there is merit in waiting to see the extent to which these past policy actions impact the economy. And I'm sure they will have the desired impact on the economy. It is the extent to which the impact is on the economy is where the debate may be. And if some time is given, I think RBI will agree with the markets that sufficient has been done not to warrant at least a lot further.
Sure. Last couple of questions. For investors who do not want to go the mutual fund route, are there any avenues available to invest directly into government debt?
Okay. So yes, there is, amongst other things, there is this direct retail scheme for investing in government debt as well. But I think it is not for any and everyone on the street. It requires some bit of understanding and financial should I say know-how to get into that space. So I would not recommend that to everyone.
So what is recommended?
Sorry?
So what is recommended?
Okay, so once again, it is about which horizon of investment one is looking at. So if somebody is looking at more than say 10 or 15 years, I would recommend a guaranteed or a par insurance product. Tax adjusted returns are far superior in those spaces, and they give you a reasonably good return. The portfolios are anyways, as per the mandate of the regulators, etc., largely skewed to long tenor government debt. So the exposure is the same. And the returns are superior, if not commensurate.
Sure. Last question. From the portfolio point of view, the way we are talking about debt right now, that it's good time to move some of your money to debt and lock in higher yields. The equity sell side is also saying the same thing. That when the equity markets are range bound, that's the time to continue your SIPs and continue your equity allocation, because that's the time that you accumulate more of equities. So from a portfolio point of view, from the entire allocation point of view, what would you recommend investors to do right now?
Okay. So personally, now is that we've said already in the backdrop that I explained that, likely that not just local but global economies will slow down, and this will probably impact, the corporate profitability, earnings, etc. Things will probably not look as rosy as they have looked, at least in terms of, the corporate earnings over last, say, 18-20 months. There is a decent likelihood that equity market returns are not going to be superior in an immediate horizon. That is not to say that one should avoid equities altogether. It is just to say that if you're choosing equity as an asset class, your horizon has to be relatively longer. So if you're looking at immediate bonanza from equity, I probably believe odds of that are less. You want to play safe, you have a requirement of playing safe, you need money, I don't know, to buy a house, for a marriage, for a foreseeable immediate usage. Some allocation can be taken out of equity, put into short-term debt instruments. On an overall balance basis, if somebody was not allocating to fixed income because over last 2 years, FD rates were 5.25%, or, bond yields were 6% odd. So if one was underweight over last, say, 2-3 year period on debt, it is time to at least become normal weight. Probably go a bit overweight and shift to equity at a time when either they time correct or price correct in line with the direction of global and local economies. So while equity allocation stays, like I said, there can be a small adjustment that is possible either on incremental basis or on a backlog adjustment basis.
Last question. foreign investor moving some of the money into long-term debt mutual funds, let's say long-term government mutual funds. How much is the annual yield one can expect for the next few years at least?
All right. So once again, because it is mutual fund, I'd say the portfolios will earn a portfolio yield of close to 7.5%, if not higher. I'm sure it will be a bit higher because, there'll be an allocation to state development loans and some, attractive portions of even credit curves. And if in at least the way that our view is on fixed income market, at least 1 to 1.5% of even capital gains can be expected over a period of 18 to 24 months.
Okay.
If not earlier.
Sure. Zoya, you have anything?
No, nothing from me again.
Churchil, we'll end it here. We promise that we won't take up much of your time. Thank you so much for joining us.
Thank you.
Thank you.